Accounting. Today we will be talking about accounting. So, what does a balance sheet entail and how does that correlate with accounting? Great question. Accounting, right, is the top. And think of a balance sheet under that umbrella. Essentially, when you deal with a company's balance sheet, you're weighing its assets over liabilities, right? That tells you if the company is profitable or not, and or if they have more assets than liabilities. If that's the case, the company has equity. Equity is ownership. You understand what I'm saying? You want a company to have as much equity as possible and as less liabilities as possible. This essentially means that the company is a robust one and that they will essentially yield a profit on a quarterly basis, right? And or annual basis, excuse me. So with that being said, we're gonna do a little reading and get busy. Let's get it. By looking at a company's balance sheet, you can address the following questions. What does the company own? Which is its assets, right? The company can the company can own assets which can be financial, tangible, and or intangible. Anytime you hear tangible or intangible, something such as this could be considered as tangible. Reason being, first and foremost, I can touch it, right? Let's say this is worth 500,000. I will list this on my balance sheet for 500,000 under the assets section, right? This causes my equity to increase. Something that's intangible, think of a stock of some sort, right? A patent, a trademark, something along those lines. It's intangible because I can't touch it, right? But it still has ownership, right? It's still considered an asset, right? So again, we're gonna start from the top. Let's go. The company can own assets which can be financial, tangible, and or intangible. An asset is anything that has value or that can be converted to or sold for cash. Financial assets can be cash investments, such as stocks, bonds, or other companies. Sorry, such as stocks, bonds of other companies, or accounts receivable. Assets can be tangible items such as inventory, equipment, and or buildings. They can also be intangible things such as licenses, trademarks, or copyrights. Everything that I just mentioned falls under the asset category, and that's what you want to see on a company's balance sheet when you evaluate the stock. What does the company owe? Liabilities. A liability is anything of value that the company must ultimately pay someone else for. Liabilities can be invoices, which is accounts payable, or short-term or long-term debt. Okay, so when you hear accounts receivable and accounts payable, that deals with accounting as well, right? Accounts receivable, essentially you're receiving money or some sort of revenue or income for the assets or whatever business is taking place, right? I.e., that's a good thing. Reason being, your equity increases when you get to your bottom line, right? Your assets increase on the accounts receivable side of things. Conversely, on the accounts payable side of things, yes, beloved, you have to pay. So that does what? It increases your liabilities. If your accounts payable is high, then it decreases your net equity. Remember, ownership is vital when dealing with businesses because it's the lifeline of the business. Let's keep it going. What is the company's net equity, right? When you hear net equity, think of net worth. Again, assets minus liabilities equals equity. You want that equity to be as high as possible. Equity, equity, equity. What is the company's net equity, right? Again, it's net worth. After you subtract the liabilities from the assets, the remainder is called what? The net worth. Net equity or net stockholders' equity. This number is critical when calculating a company's book value. So write this down. Net worth, net equity, or net stockholders' equity. Those three things essentially mean the same thing, right? And you want all three to be as high as possible. Reason being, the company is a robust one, the higher that number is. This is where you get into small caps, mid caps, large caps, and mega caps, right? Mega caps, their net worth is astronomical, right? Those numbers have zero, 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 and commas, 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 because they're considered a hyperscaler. Whereas someone on the small cap side of things, right? Their net equity or shareholders or net shareholders equity or net worth, right, would be on the lower side of things because they're just starting out. So thus you have to ask yourself, are you willing to take more risk in a small cap company with potential growth, or do you want to just invest into a hyperscaler such as Amazon, Microsoft, Alphabet, you know the rest, right? Know the difference and know what you're getting into prior to investing into a stock. And with that, even down to the company's book value, that's another thing, and we'll get into in another video. A company's book value tells you a lot, because once you know a company's book value, you essentially know what the company is really worth, right? The true essence of a company. So thus, if the market value is much higher than its book value, that tells you that the stock is overpriced, right? Some people buy overpriced stocks, right? Whereas intelligent investors, they wait till that market value drops down to its book value so that they could get the price that an intelligent investor would seek, rather than someone who's hungry, thirsty, or lacks knowledge. Knowledge is imperative. We'll get into book value going forward. Stay tuned, stay focused, heavy on the investment.